You're listening to the Practical Tax Podcast with tax attorney Steve Moskowitz. The information contained in this podcast is based upon information available as of date of recording and will not be updated for any changes in law or regulation. Any information is not to be considered tax advice or legal advice and does not form an attorney-client relationship. Further, this podcast may be construed as attorney advertising. You should seek professional consultation for your individual tax and legal situation.
Welcome to another edition of Practical Tax with tax attorney Steve Moskowitz. Steve, there's been a lot in the news recently about interest rates and refis and you know how that's affecting the country, the industry, and everything that goes along that. You know, I remember in the past people said when interest rates are high, people tend to, instead of sell, they do repairs and additions and upkeep and stuff. But I don't know where we are right now with that number. You know, if it's a number that we're going to see smooth out soon, will Powell, do that, or will we continue down this road? Joining us right now is Kevin Lyons. Kevin is the CEO of Anchor Funding and an old friend of mine. I've known Kevin for a long time, and he's nice enough to join us here with Steve Moskowitz on Practical Tax. Kevin, hello.
Not very old, Chip.
Right.
Thanks, Steve.
Hi, Kevin. How are you?
Good, guys. How are you?
Great.
Good. Let's just jump right into this. We've known each other a long time, and we've spoken over the last 15 years, and we've seen interest rates go up and down. Let's talk about where we are right now, and how do you feel people are responding to the higher interest rates? Again, those of us who lived in the 70s, like Steve and I, they don't seem that high. But how are people responding to you right now when you're talking about everything from new mortgages to refis?
Well, we've had a really good run the last few years. So everyone's taken advantage of incredibly low interest rates. But if you look at interest rates over the course of time, and you guys obviously remember, and so do I, and any viewers watching, rates in the 80s and 90s and early 2000s were a lot higher. So when you go from rates in the
remember in the 20% bracket.
Yeah, exactly. It was, and when you got 15% and 10%, that was a good rate. So the sticker shock that's come into play is rates in the 2s and 3s suddenly becoming 5s and almost as high as 6%. So anytime you get that, you're going to get a change of scenery, and the scenery's changed. However, it looks pretty good for the long term.
Yeah, we're both all in California, all three of us. And here's something that always occurred to me. So people might put off buying because the rate went up a little bit, but the housing market doesn't seem to be slowing down at all, and it's continuing to move. Does it make sense to still buy at a little bit higher rate to offset the increase in the value and cost of homes as they go forward?
That's an interesting, that's a very interesting question, and we have that conversation pretty much daily. And my personal opinion is yes. And the reason I say that is, and this is obviously my 2 cents, the Fed has done a really good job of raising rates really quickly. In fact, there's a 3/4 point hike coming up shortly and another 0.5% in November. They've taken such extreme measures in such a short period of time that ultimately they're going to have to take the opposite path. And when they take the opposite path and start dropping interest rates, home demand is high. I mean, there is still a huge amount of demand. COVID has changed the landscape. So people are working from home. So this idea of working in the same city is gone. You can work anywhere in the nation now. So home demand has shot up. So we're seeing crazy high coming down to busy. And what we're expecting in the next year to two is, as soon as the Fed does decide to drop interest rate, these home prices are going to continue over the course of time to go up. Your home is your best investment. So if you wait now, granted, you may get a lower interest rate in a year or two, but the chances of getting a better home value, in my opinion, are diminished.
I bought a home in '79 at a huge double-digit rate, right? And we sold it 25 years later with a 300% increase in value. It was outside of DC, but nonetheless, it's all relative to where you live and the money you earn and the taxes you pay, depending on what part of the country you're in. That was, to me, always an intriguing question is, what's going up quicker, the interest rate, which we know abates and drops eventually. But other than the bubble we had in '08, which was really not about the housing market as much as it was about just bad banks and bad practices, it seems to me that that's a really good way to go. So, but when I mentioned this at the top, Kevin, but Steve, let me ask you this before that though. If I took money out of my home for like repairs, like the equity that I have in my home. And I'll ask the second part of this is, how do you recognize equity, real equity, Kevin? But the first question is that interest that I borrow on that, is that still tax deductible? Because I remember at a point it was 100% tax deductible.
So that's changed. It used to be 100% deductible no matter what you did with the money. Then they put a cap on it at $1 million. Then the cap came down to $750,000. And what a lot of people don't realize is if you refi, you only get to deduct the interest on the money that you use to repair the house or get a bigger house or an addition. And they even took away the extra $100,000 for a credit line. So the bottom line is, yeah, they take a look at it. So when people refi, say, okay, it's real important, again, keeping records, because I was a CPA before I was an attorney, tax attorney. It's you have to show, well, this money because what happens is most people don't separate it. They just take it, and the government says, well, you paid off some credit cards and you made some improvements. Government takes the position that since you can't say which is which, that you use the money from the house for the credit cards, no deduction for you. So what you want to do is you say, okay, you very specifically put it in separate accounts and say, all right, this money that I took out of the house, I use it for improvements. That's tax deductible. And there's another trick too. It's the Voss case. The IRS always said that the limit was per house. Mr. Voss bought a house with his girlfriend, and Mr. Voss said, well, okay, I get a $750 and my girlfriend gets a $750. And the IRS said, oh, no, Mr. Voss, it's $750 a house. The tax court said, no, Mr. Voss is correct. It's $750 per taxpayer. So one of the tricks here, suppose boyfriend and girlfriend buy a house that's common. If they got married, they could only deduct $750. If they live together without marriage, they could deduct $1.5 million. So again, the minute you ask me something, it's having spent my life in this, it's, well, wait a minute. The way to do that is this. It's kind of like why the Fortune 500 doesn't pay any taxes, because they have an army of people like me saying, no, wait. Don't do it that way. Do it this way. And the last thing you want to hear from your lawyer is, oh, too bad you did it that way.
That's tax attorney Steve Moskowitz. Kevin Lyons is with us here. Kevin, how do you know what's real equity and what is just a bit of a spike in the market?
I think equity is equity. So when you get your house valued through an appraisal, and that's what an appraiser believes your house is worth, and you look at what you owe versus what it's worth, that's your current equity position at the time. So in regards to a spike in the market, yeah, I mean, we had borrowers coming to us over the last year who wanted to borrow up to 80%, or in some instances, 85% of their property values. They can go up to 90% with VA. And our advice to them has always been, just understand that once you take this cash out refi, you got to live with this mortgage. So, if there's ever a downtick in rates and you want to refi down the road, you may not have as much equity as you need. So I think we always tend to heed to the side of conservatism. We like to see people getting up to 70% loan to value, maybe 75, always giving themselves a 5% buffer in case of emergency or when they want to refi. So we definitely have a lot of equity right now. Are we going to see a big diminish in it? No. As I mentioned earlier, I don't think property values are taking a dive. And you mentioned as well, there's nothing to put them in that direction. There's no bad mortgages out there that are pulling the market down. So real equity is what, in my opinion, what your house appraises for. And perceived equity is just be careful and don't overdo it.
And also, the thing I would throw in, it depends an awful lot on what do you plan to do with the money.
Correct.
If you say you're going to take money out of the house and go on a wonderful vacation, maybe that's not such a great idea. On the other hand, if you say, look, I have a really solid business idea, but it needs some cash. In that case, you might want to say max out the equity every penny you can, because you believe that for every dollar you take out of the house, you'll get multiple dollars back from your business investment. So when clients come to me and ask me that question, I say, what are you going to do with the money? And then you make a decision. And I realize there's risk in business. And what you talked about having the buffer, that's really good. But again, business is about risk. How much risk tolerance do you have? Are you willing to take the risk to make the bigger money? And that's an individual decision. And with most business owners, they essentially do put their house in the business because at some point they have to borrow money and they guarantee it with the house.
After the '08 Great Recession, Kevin, the government obviously put its foot down on banks for a long time, and we've seen a change, not subprime kind of change, but like with business loans and non-QM loans, non-qualified mortgage, people that had their own business that wanted to get a loan. Is it easier now than it was like 5 or 6 years ago for a small business to get a loan?
Well, resting on Steve's point, and he mentioned, pulling equity out on your home, like on a cash out refi, if you've got a business. And, in that particular instance, we are seeing folks who are self-employed, pushing the equity in their homes as far as they can, because it makes good business sense to pull money out of their home.
And if you use the money for a business, the interest deduction is virtually unlimited.
Yeah. So I totally agree with you in that respect. It makes perfect sense. And Chip, what we're seeing right now as well is a lot of folks are coming to us to do what are called business bank statement loans, where they make great income, but they take advantage of their write-offs and their bottom line on their tax return. Like the painter who's making $2 million a year, who shows $100,000 on his tax returns because he can, and he's taking advantage of all his write-offs, but he's got $160,000, $170,000 a month going into his business. So the industry is cottaged into this full-fledged plane where we can take 50% of those deposits and we count them as income. So all of a sudden, someone who couldn't qualify can, because the bank's going to turn him down and Fannie and Freddie won't qualify him, but his business deposits allow for it. And we're seeing that for business owners to put into their business. Funny enough, we're also seeing people using it for ADUs, accessory dwelling units, when they just want to add value to their home. So yeah, great angle.
And
there are tax implications of all this, right, Steve?
Chip, another thing I would throw in there is exactly what we're seeing here, is that suppose that statement shows, you have $100,000 in profit, and you say, well, wait a minute, I have $2 million in depreciation. I didn't write a check to depreciation. I have that money sitting in the bank, or I have it in another investment. But in reality, I made a cash profit of $2,100,000, but through the use of depreciation, I don't write a check to depreciation. It's just a paper entry that my tax return preparer has. My tax return legally shows $100,000, but really I made $2,100,000. And we want to talk to them about, what does it really mean?
Pretty great stuff. Kevin, will you come back and talk to us again, please?
Absolutely. I thoroughly enjoyed this. It's right up my alley. I appreciate being a guest, and thank you both.
Thanks so much.
Again, Anchor Funding CEO Kevin Lyons. Thank you, buddy. We'll see you soon. All right. So time now for Ask a Tax Attorney. This is a question I think that a lot of people struggle with. And that is, they get something in exchange for a service that's not cash. And they don't put it on their taxes, because most people, it's not like babysitting money. I know. Let me ask the question.
Naughty.
The question is, if somebody gives me, for example, I work on their home. Say I'm a carpenter and I just do some work, and they give me a gift certificate for like $150. I mean, that's different than giving me a car or something like that. Where is the line, and how does the IRS view this?
So the bottom line is, and IRS looks for barter, and there's actually barter exchanges. If you go ahead and you exchange services or anything else, you report as income the fair market value of what you gave. So suppose, for example, you come into somebody's house and you're a house painter and you paint the house, and the house owner says, okay, in exchange, I'm going to give you a painting worth $10,000. You're supposed to put $10,000 on your tax return. And what happens is there's a big difference between a gift and an exchange. In the house painter example, there was no gift here. The homeowner said, I want my house painted. And the house painter said, well, okay, I have my eye on that painting over your fireplace, and that's worth about what the paint work is worth. You say, okay, well, that's an exchange. That's the same as if he wrote him a check.
Right.
What a gift is somebody says, it's disinterested generosity. You're not looking for anything back. So it's happy birthday, Chip, and here's, some gift. That's different That's different because you didn't do anything for it.
Yeah, but how does the IRS even track that stuff? And does it ever come
That
up?
doesn't matter.
No,
What
I know that.
matters is I'm
But I mean,
telling you
that's
what the law is, because basically the law says that's what you're supposed to do. How the
right.
IRS tracks it or finds it doesn't matter. As a tax attorney, my advice is always comply with all laws. The law says you're supposed to do it.
Sure.
It doesn't matter how they track it or not.
I guess the thing that people, the examples that we gave, it's when the exchange is. I mean, obviously, if it was $100, if somebody gave me a gift card, that's different than.
No, well, Chip, no.
No, okay, all right.
If there's an exchange and the guy gives you $1, that's income. An exchange is you did something in exchange for something. Chip, I want you to do X for me. And you say, okay. And you say, can I have that tie? If I run that errand for you, can I have that tie? I say, okay, take the tie, I'll give it to you. The fair market value of the tie is income you put on your tax return. On the other hand, if I say to you, Chip, happy birthday, I got you a new tie. That's not income, it's a gift because you still received the tie, but you didn't give me anything back for it. It was disinterested generosity. That's the difference. The exchange is taxable. The disinterested generosity is a gift.
What's the creation? This is kind of a tangent, but what's the creation of the IRS in essence, or taxes? And what was it, the 16th Amendment? I forget whatever amendment was.
So this was in 1913, and I was not in practice at the time. Just want to clear that up. The income tax came in as, quote, a tax on the wealthy. The top tax rate was 6%. And in order to be in the 6% bracket, you had to be making, remember, in 1913 dollars, over $500,000 in 1913. Basically, it's like, okay, who in Congress was mad at that was wealthy? That is how our income tax law started. As you can see, it's changed quite a bit.
The final bill increases that maximum standard amount next year to $12,000 for an individual, $24,000 for couples. Charities are already expressing worry that fewer people will itemize, and without the tax break, that will reduce incentives for giving.
As a doubleheader for Ask a Tax Attorney with tax attorney Steve Moskowitz, I want to talk a bit about charity and how the IRS views that and how they have over the years and how states view it. My wife and I, every other Saturday, it seems like we're going to Goodwill and we take it down there and they write out a receipt. I don't know. I never even put it on my taxes, to be honest with you. And I know I probably could. And you would admonish me too, because it's legitimate and honest and fair. Right. But, they value it crazy.
So let's start off with the receipt.
All right.
The typical receipt that people get, if they get any at all, is 3 bags of clothes.
Right.
That receipt is not worth very much. What you need to do is have an itemized listing. So, for example, one man's suit, one woman's dress, one TV set, one toaster oven. And then what you do is you put the original cost, its condition, the fair market value, and then you have the charity acknowledge that that is what they received. That is much better. And when you're dealing with charities, there's a lot of fancy things you can do. For example, the stuff you're talking about, giving some stuff to Goodwill, it's a relatively small deduction, although they add up because, people clean out their closets and there's a lot of people that buy expensive clothing. They don't wear it very much or they change the size and they give it away. It can add up to, a nice deduction. But we take a look at some really fancy deductions. Suppose we have this situation. Suppose we have husband and wife, they don't have any children, and they say, we love our house and we want to live in our house for the rest of our lives. But when the second of us passes, we want the house to go to the charity of our choice. That's nice, but that's no tax benefit. How do you get a tax benefit? So you do a charitable remainder trust. And what happens is everything physically is the same. The husband and wife live in that house for the rest of their lives. If they live another 300 years, so be it. But the day you make that gift today, an actuary comes in and based on the husband's and wife's ages, makes an actuarial determination of what they kept, called the life estate, and what they gave away called the remainder interest. So let's make up a number. Let's pretend that the equity in this house is $1 million. And the actuary says, what you kept is worth 300. What you gave away is worth 700. Chip, you have a $700,000 tax deduction. And you say, well, wait a minute. Physically, everything's the same. In both examples, husband and wife live in the house until the second one dies. The first way, there's no tax benefit. The second way, oh my God, you got a $700,000 tax deduction. It's because you set up the CRT, charitable remainder trust. That is a way where you can see. That's what tax planning is all about. That's why when somebody says, here's what I want to do. I want to give my house to charity. Okay, but there's a big tax incentive to do this. So now, what if you say, well, you know what, Steve, I don't have $700,000 of income. I can't use a deduction that big. You can carry it forward for 5 years. And the bottom line is, that's why when I do tax planning, I say to people, what do you want to do? And they tell me, I say, well, you know what? Doing it your way, there's no benefit, but doing it this way, there's a benefit. And one of the things that I bring up is that you can have a situation where you have twins that have identical income and assets, but their planning is very different because somebody else says, well, I don't want to do that. I want to do something else. And these are all things that you can do. And charity is very favored at tax law. There's a lot you can do and everybody benefits. Here, the charity benefits because they get in the house eventually. You benefit because you get this giant tax deduction. You just pay less taxes.
Well, what about this? If I want to get a tax deduction, do I have to donate to a registered charity?
50c3 organization. So yes.
Okay.
So it's not like, my neighbor is really.
I can't give money to a homeless guy on the street and ask for a receipt.
No.
Okay.
You need a 501c3 organization.
Okay.
Well, what that is in English is, in the old days when things were in paper, used to be Publication 78, there was this giant book that had all the charities listed in it. So basically, yes, it has to be a recognized charity. So if you just help out your neighbor or some guy on the street, that's a nice thing to do, but no tax deduction for you.
Second question. If I work for a charity and I get no remuneration, right? Can I deduct my transportation or clothing or something that, if it's a job, I'm going there, but I'm not getting paid, it's charitable. Am I entitled to any deductions?
Minor deductions like your transportation costs, where a lot of people make a mistake. You're not entitled to the fair market value of your services, but you are entitled to your transportation costs. If you have any out-of-pocket expenses. So suppose, for example, you say, you know what, the people here in this neighborhood, they desperately need crayons for the kids for school. I'll just buy some and give them to them. The cost of the crayons, you can deduct.
Or, if we're sweeping the streets, like a broom, whatever, that kind of thing, but not my actual labor is not part of that deduction. Interesting. And how much, I guess it's interesting. I know that I remember the famous story. We might have talked about this in the past about Carnegie, who was not an especially charitable person until after the Johnstown flood. And it kind of changed his life because he actually owned the water that was above the town where the dam broke. And it changed the way people kind of looked at charity in this country. And after the Great Depression, obviously, I had a grandfather who lived in DC and was fortunate to have a job with the post office, and people would knock on their door and he'd bring in, I wasn't alive, obviously, but he would bring in people to eat at their table and give them what they had. It's a big part of our country. And do you think the IRS does enough to recognize it and to reward it with?
So the IRS doesn't recognize or reward anything. Congress makes the law. IRS is the cop. IRS enforces the law. They don't make any laws.
But do you think we do? Does giving money to a charity and that process, does that help the overall economy in ways? Obviously, if the charities are getting private money, they don't need government money, right?
Depends who you ask. If you ask a charity, they'll always tell you they never have enough funding.
Right. Makes sense.
Ask them if you need money. They never have enough. And then, there's all kinds of arguments about charity. For example, if you take care of somebody and feed them and maybe give them a trade or something, train him for a job, now he becomes a productive citizen, as opposed to, he goes through life and he can't support himself, needs some government agency to support him. there's a lot of good things for charities. Other people say people take advantage of them. Like everything else, depends who you ask.
Yeah. Well, that's another edition of Practical Tax with tax attorney Steve Moskowitz. And you have a great weekend, my friend, and we'll see you next time, okay?
Take care. Thanks so much.
The Practical Tax Podcast with tax attorney Steve Moskowitz.